Hello again, RoyZesch.REALTOR with Coldwell Banker Legacy in San Angelo. Today we're going to continue our series on the buying and selling process. Last time we talked about the option period, where you have a chance to do inspections and figure out if repairs need to be made and negotiate that on a repair amendment. And then we talked about contingencies if another property has to sell. One thing you need to remember in all of this process is really once you're under contract, the seller is really committed. There's not very many ways for the seller to get out at this point. But the buyer, there are multiple ways you can get out. You have the option period, you have the contingency if the property doesn't sell, then you have the stuff we're going to talk about today, which is basically the lender stuff. So in most cases, there will be a lender involved in this whole process. So the way that works is when you start the process, there's what's called a third-party financing addendum. That's part of the original contract, and that says that all this is contingent on the buyer being able to get financing from this lender at a certain interest rate, certain terms and whatnot, which are usually fairly standard. That's not a big deal, the terms and stuff, but they have to be able to get the financing. Now, typically, you know at the point of accepting the contract that the buyer has been pre-approved, but pre-approved means they're generically approved, okay? There's lots of things that can happen between the pre-approval process. That's not the lender saying we're gonna loan them X amount of dollars to buy a house, period. There's two things. First off, something can change in the buyer's situation between the pre-approval and buying the house. One of the most common ones is somebody thinks, oh cool, we're getting a new house, we need a new car. So they go out and buy a new car, and the new car puts their credit over the limit where all of a sudden they don't qualify for as much as they did before. So that's a way people can get themselves in trouble. So don't do that. The other things that can happen is the lender has to approve the house. So there's two or three parts to that. One is an appraisal. So in an appraisal, an appraiser goes out, the lender hires an appraiser and sends them out to do an appraisal of the value of the property. The appraiser is doing this to protect the lender if the property is not worth. So if you're buying it for $200,000 and the appraiser goes out there and says it's only worth $180,000, then the lender is not going to loan $200,000 on that property. So what has to happen then is you have to negotiate back down, or the buyer can get out of the contract at that point, or the buyer can bring more cash possibly and get it to a position where the lender will lend on it. The other thing that typically there will be an insurance review. So the buyer will have to have some insurance company ready to underwrite this property once it'll be fully insured on the date of closing. If there's any issues that, even say in the inspection you notice there were some issues with the roof, you didn't think it was a big deal, and so didn't get it negotiated at that point, but now the lender comes back and says, no, this property, the insurance company said it's uninsurable. Since it's uninsurable, we're not going to lend you the money on it. So that's another issue you can run into at this point. And then basically there's the thing we talked about briefly before, is there's an issue with the buyer's credit in this time frame. They could lose their job, many various things could happen. Something could get reported that happened 2 years ago, but now all of a sudden it gets reported to the credit bureau, so when they pull their credit again, it throws things off. I actually heard of a case recently where a buyer filed their tax return on time, or actually they filed it a little bit early to get a tax return, the refund back earlier, but in the process of doing so, now that's information that's accessible to the lender, and their financial situation had changed. It was reflected on that tax return. So then they were borderline on qualifying, or maybe even didn't qualify and had to work on it a little bit. So there's still some things, even at this stage of the process, that can throw things off from the lender's point of view. The one other thing is the title commitment. You get a title policy issued when you buy a property, and basically that is the title company, they research the title, they find out if there's any issues with the title coming up, if there's liens against the property, stuff like that in the past. Any deed restrictions, anything weird that can show up, utility easements, all that kind of stuff. If there's a red flag on there, then that's another place that the lender can say, well, no, we're not going to lend money on this property. So there's still some things that can work through at that stage. So again, there's several possibilities for hiccups in there, and that's one of the things that your realtor is responsible for. He stays in the loop on all these things, knows what's going on, and helps work through the hiccups, figure out if they could be negotiated out. Sometimes, the appraisal comes in $5,000 short, and maybe that can be negotiated between the two parties. Maybe it cannot. But again, it's another thing that has to be negotiated. So the key thing to remember is don't relax when the house is under contract, whether you're the buyer or the seller. There's still lots of places along the way things can go wrong, they can get off track, and a lot of places it can get derailed if someone's not taking care of it. So it's a lot of the things that a realtor has to do at that time. So if all these things go through, then you come up to a closing date. And so the closing date's scheduled. Both parties will go to the title company. They'll have separate signing sessions where they sign all the paperwork. One buying the house, one and the loan and all that stuff, the other selling the house, and then the title company will get money from the lender. They will pay all the bills that need to be paid, pay themselves for the title work they've done, the title insurance policy, and then they will pay off the debt of the seller. And then if there's any remainder left, it will go to the seller if they had any equity in the house. Whatever has been negotiated in the contract, the title company will take care of all that. And then they will record all the documents with the county showing that the new owners of the property are the buyers. So it's not simple, but there's a lot of steps to the process, but it happens over and over again all the time. It can be done. But again, there's reason to have a real estate agent to help guide you through that process, because there's ways it can get derailed. Give me a call, RoyZesch.REALTOR, 325-268-0775. Thank you.